So, someone recently asked me how does the Fed change the federal funds rate and what do they do in the meeting after an inflation data is released? I think it's a great question. Let's break it down step by step. So, let me explain the first part, which is how does the Fed change the federal funds rate? So, the process starts with inflation data. Each month, the government releases reports on inflation like the CPI, which is the Consumer Price Index. If inflation is rising too quickly, it means prices are going up noticeably, and this can make everyday goods and services more expensive. The Fed wants to keep inflation stable, usually around 2% so that they keep a close eye on these reports. After the inflation data is released, the Fed's policymakers, a group called the Federal Open Market Committee or FOMC, meet to analyze the data. They look at the current inflation numbers but also consider things like unemployment, economic growth, and other financial conditions. If inflation is too high, the FOMC might decide to raise the federal funds rate to cool down the economy. But if the inflation is low, they might lower the rate to encourage spending and investment. The FOMC meets about 8 times a year, usually every 6 to 8 weeks. This meeting is where the discussion about whether or not to change the federal funds rate is made. The FOMC is made up of 12 members, 7 governors from the Federal Reserve Board, and 5 presidents of the regional Federal Reserve banks. So during the meeting, they discuss current economic situation, including inflation, unemployment, and growth. They also review any other factors that could affect the economy, like global events or shifts in the financial markets. So after this discussion, they vote on whether to change the federal funds rate. If the inflation rate is higher than the Fed's target, which is around 2%, they may decide to raise the federal funds rate. By doing so, they make borrowing more expensive, which can slow down spending and help lower inflation. If inflation is too low or there's a risk of deflation where prices actually start falling, the Fed may decide to lower the federal funds rate. So, lower rates would make borrowing cheaper and it would encourage spending, investing, and overall grow the economy. After the FOMC meeting, the Fed makes an official announcement, and this usually happens at 2 p.m. EST on the day of the meeting.